Good morning, ladies and gentlemen, and thank you for joining us for our inaugural banking webinar. We are very glad and humbled that you've spent time off your busy calendars to join us. And I'm very excited because I'm very sure, knowing what is coming up over the next hour, that you've actually made the right decision. So, Zamara is a financial services firm and has been in existence for over 25 years. We focus on pensions business, insurance broking, and actuarial consulting. In Nigeria, we opened an office in 2017, and we do provide actuarial consulting services to a number of insurers and to a number of companies that have IS 19 arrangements. We are, however, now providing banking consulting services across a number of jurisdictions, and that is exactly what we will be focusing on in our session today. So Zamara has partnered with Analytics Engine, and I'm very proud to have the CEO on the line today. Pravin will be shortly sharing the details about some of the technical elements of the banking space. Pravin is the CEO of Analytics Engine, and Analytics Engine is a data analytics company, so a boutique data analytics company. And I find I've worked with them over the recent past, and I believe there's a lot that you're going to learn from this particular session and from the experience that Analytics Engine brings to the table from its consulting experience.
The bank's challenges we actually have in the banking sector, which is, as I mentioned earlier, which is part of them are bad loans, which actually go bad a lot of times. Which of 2019 reforms we actually try to address, and then the low capital base, which 2004 reform, bank sector reforms was trying to address, and which they address properly.
Although the definition of risk-based pricing is being able to charge clients the correct risk-based price. So customers who are good risk should present with a lot less or lower price than customers who are bad risks. Often, though, it's not just risk-based pricing, but often risk and opportunity-based pricing, because as part of setting differential pricing, what banks will often do is charge customers based on their risk, but also on the opportunity from a relationship banking perspective. So really good clients who present lots of value to a bank may get a discount, and clients who are perceived as being risky will have a higher price. So risk-based pricing, to sum up, means differential pricing on a fairness basis. Very importantly, when doing risk-based pricing, it's to ensure that the factors that are used to differentiate price do not discriminate and are fair to all your consumers. Okay, if we look at some of the key statistical models and mathematical models that you need to execute on this infrastructure. The first one is segmentation, and that is quite important. So how do we focus on micro segments beyond the norm of just income and age? Because often banks, I've seen generally, use income and age and have well-established reporting on those lines. But how do we create more micro segments so that we can learn about our customers better and react to them better? How do we measure profitability, the net present value? The present value of facility level cash flows with deal hurdle rates, to make sure that when our frontline is negotiating, that they're not giving away profits that we can't afford to give away, that they're giving away within tolerances. That becomes very important to make sure that the new business we're writing is quality new business. Then we're very interested in the lifetime value of customers. What else is the value of this customer to us? What other products will this customer buy? How long will he stay with us? And these should inform the concessions that we're willing to make to a customer. The better the lifetime value of the customer, the more likely we are at a principal level, and again, this comes back to the principles, to be willing to negotiate with the customer and also to focus our marketing efforts on the customer. The very important parting shot, I would say, is to set your own strategy. Rather than reacting to the strategy of your competitors in the market, focus on understanding your own book and decide where you want to win. And that's the best route to success, in my opinion.
My name is Seth. I've been your moderator. I will finish it in similar fashion of how we started it. Thank you for attending this session. Thank you for your questions and engagement, both before the session and now. Risk-based pricing and treating the customer fairly. This is the start of a series that we will continue to have. please reach out to us and we'll try and tailor these sessions to some of the questions we're getting. And the very last statement I would say is, yes, we are asking you to consider changing some of the practices that you have. But as Deming, one of the fathers of management, said, change is optional, survival is optional, but in order to survive, you have to change. Thank you very much. I've been your host. Thank you, panelists. And thank you for all of you who have spent an hour with us. Have a lovely afternoon, I believe, in Nigeria. Have a lovely afternoon.
Thanks, Ed.